Hello there, everyone. Welcome to the weekly chat with myself and my mate Ralph Hebgen, who was an equity research analyst for over 20 years and someone who I have worked with and known for over 20 years. We're going to be talking about three things that emerged from the news this week. First of all, China and Taiwan and how likely an invasion could be. Secondly, the prospects for UK supermarkets as they seem to have surprised on the upside with their Christmas performances. And thirdly, the financial sector, namely the consequences of a lack of M&A activity and what accountant EY could do with a $2.5 billion war chest. So there we go. That's what we're going to be talking about today. So, Ralph, let's start talking about China-Taiwan. Now, the thing is that obviously this week we have seen defense agreements being signed between the US and Japan, the UK and Japan. I mean, there's been lots of tension build up for quite some time now, but obviously it's intensified since Russia's invasion of Ukraine. So, you know, on the one hand, you know, it is understandable that those in Taiwan are being increasingly concerned. Those within the sort of Asia Pacific region as well have been concerned. But, you know, how likely do you think it is?
Well, this is, of course, a very difficult question to answer. But in general, first of all, the wider framework is, of course, exactly as you characterized it. China has for a long time prepared itself to become the hegemonial force in the Southeast Asia.
Mm-hmm.
America has for a very long time implemented a strategy of diplomatic ambivalence. They weren't really clear on which side they were going to come down on, and that was deliberate. Recently, they have changed this ambivalence and have become a lot more clear and vociferous on the side of the outcome that if China were to invade Taiwan, they would actually not stand by idly. They would actually support a military opposition. And of course, this is what we are seeing now with the US-Japanese defense agreement, and also there were some others from Europe, the UK defense agreement. So I was wondering recently, how likely actually is it that China wanted to invade Taiwan? How imminent might this be? Would there be any early indicators, any warning signs that of an impending invasion? And in fact, I can sort of cut to the end of what I'm going to say, and I'm going to say that I do not believe it is likely to happen this year, or perhaps even within the space of 2 years. Now, that might provide very little comfort, because it is possible, surely, to be happening within the next, let's say, inventor number 5 years or 10 years. But I do not believe that it is short-term, if short-term means this year or next. And the reason why I say that is that China wouldn't be able to just simply invade Taiwan. This is actually quite a large and extended and complicated operation if it were to happen. For one thing, they would have to start stockpiling ammunition, mass manufacture ammunition, missiles, air-to-air missiles, anti-ground missiles, things like that, and any ramp up in production of that ammunition at a capacity that would be required would be visible to observers outside. There are signs that China is ramping up production, but these signs are as yet very minor, and the indications, as far as I can see from the research that I've done, are that this is not on a scale which would allow an invasion this year or in the next 2 years. So that's point number one. Point number two is they would need to insulate their economy from the outer world. So and that would mean more stringent cross-border capital controls, of a nature of, first of all, to freeze any foreign assets which are held within China, and second, repatriate any assets which China holds outside. And this is, of course, obvious why this would need to be done, because, well, not that China would have needed to see the lesson from the Ukraine to know this. It knows full well that if it invades Taiwan, then Europe and the free world would retaliate with sanctions of a nature which we have now seen highlighted in the Ukrainian war. So if anything, Putin's invasion of the Ukraine has driven home, I think, in China, the clear conviction that it would need to insulate its economy against any such sanctions which Europe plus the free world would be sure to implement, and that would mean that it would need to repatriate all its assets from outside of China, and that has definitely not happened. Then there is a third thing which relates to the military, the PLA, the PLA, and that is that they would need to stop any demobilization which is happening just in the normal course of events. So all demob activities from the PLA would need to be stopped. Key personnel, military, and also key Chinese functionaries, elite functionaries, would have travel impositions, and again, that hasn't happened. So there is a further list of minor points which I will not mention, but the list is long. I've mentioned three major categories. None of them have happened in a major way. So I don't believe that we are seeing the early indicators which we would need to see if an invasion was imminent, and again, imminent means this year or next.
Fair enough. Very interesting stuff, because I think, obviously lots of people are getting nervous, but I think you make some very good points there. And yeah, so obviously we're not saying that it wouldn't ever happen, but like you say, a lot of things would need for it to happen. It needs to be more than, saber rattling, which is basically going on at the moment.
Mm-hmm.
Okay, so let's move on to the second topic conversation today, supermarkets. Now, the thing is that obviously the whole retail sector has been on tenterhooks at the end of last year. Obviously, cost of living crisis. We've been hearing a lot about the rising inflation, all these kinds of problems, energy crisis, all this kind of stuff. And everyone from within, I'd say, retailing and actually the leisure sector, so including things like, restaurants and pubs and that sort of thing, everyone's been panicking about Christmas, because the final quarter for retailers is known as the golden quarter. This is the one where they make most of their money for the year. It's been disrupted for the last few years, and so therefore this year is it's always important, but this year's been particularly important. And we've seen the battle in the supermarkets in the lead up. I remember last year there was talk, and Sainsbury's, they were allocating, I've forgotten how much it was though, it was a huge amount of money. Was it 500 million quid? I've forgotten, but anyway, it was a lot of money that they were using to try to keep costs down. And then you've got obviously the discounters, Lidl and Aldi, doing particularly well. But anyway, at the end of the day, most of them did pretty well. So you had Tesco's did very well, Sainsbury's did very well. They had like one of the best trading days they've ever had. Lidl, Aldi also did very well, and it does kind of make you think, well, is this leaving behind the likes of Waitrose? Because I think, the reason for going to Waitrose now is, I'd say, diminishing potentially, and you do wonder whether Waitrose is actually going to do anything, because it seems to me that since Dame Sharon White came in to a very troubled, John Lewis and Partners and Waitrose, she has done a lot of, well, she did a lot of, hacking initially, but then there was a lot of things going on with regard to, little ideas, but they were all seem to be at the periphery of the business. And I've been saying for a long time now that, it seems to me that she's not actually doing anything with the heart of the business, actually doing something with the supermarkets, doing something with John Lewis. Not really. They talked about things like moving into becoming real estate, so becoming landlords, buying up properties and that kind of thing. But that's all round the edges. So anyway, the main sort of upshot of all that is most of the supermarkets have done better than expectations. Waitrose, I would say, it stands out from the fact that there's less reason to go there, I think now, and it needs to do something drastic, I think, in its core business in order to pick up. But I think generally speaking, if we take Waitrose aside, the fact that we've seen a better than expected performance of UK supermarkets generally would suggest that actually things aren't as bad as everyone's saying.
Yeah.
And what does that mean for supermarkets going forward? I mean, I would say maybe it's going to be a bit subdued post-Christmas initially, because it always is, because people feel like suddenly, the lack of money in their accounts, etc., felt particularly acutely in January. But yeah, what do you think, Ralph? Do you think that, what do you think of the prospects for supermarkets, for this year, for instance?
Well, yes. I mean, again, it needs to be put into a wider framework, and with that wider framework is, of course, inflation. And just one thing which I wanted to pick out here is that prices for gasoline at the filling stations has also dropped relative to its peak, which we saw in July last year. And so clearly this is not good news in itself. Inflation is crippling. There is no question about it. But the actual situation of household incomes, I think, in the country is a little bit better than an absolute catastrophe. And I'm smiling because, yes, it is absolute catastrophe, which is the benchmark against which we are increasingly need to measure reality. But anything which isn't as bad as that is actually better. And so that is, I think, what is happening. I mean, inflation is forecast now to tail off. We haven't quite seen the turning point yet, I would argue, but the turning point is in light of sight. I think next month might actually be the peak of inflationary pressures which we are likely to see. And then from there onwards, it's going to come down. Just last week, of course, we mentioned that most observers still see two possible rate increases coming in interest rates. So the pressure on mortgage rates is still going to go up, which is a notable expense item in most people's household P&L. But at the same time, also we see fixed rate mortgage deals coming up now, which are quite reduced to where they could have been expected to be, and that's a direct consequence of house prices falling in the UK and banks scrambling for business in terms of mortgages, which they can sell. So the pressures on household incomes, I don't think, are quite as severe as many will have had reason to expect. And because of that, I think there is slightly more money available for people to buy food. That is the reason, I think, why the mid-market supermarket subsector, the Tesco's and Aldi's of this, that's a German one, the Tesco's and Sainsbury's of this world, and Asda's, that's what I wanted to say, Asda of this world, have actually done better than I would ever have expected them to do. It is not surprising that the discounters Aldi, now it is correct, Aldi and Lidl have done very well, but it's that mid segment of the market which has done well. And so I think that's why I think this has happened, if you put it into the wider context of the household P&L. Quick word on Waitrose. Yes, I would agree. Waitrose is probably in a tight spot because on the one hand, it caters for a market of the more affluent people, who, of course, also have now become more price conscious. And second, I would argue its direct competitor is M&S Food. And I've just been there just yesterday, and I must say the prices there are much better, and the food quality is at par with that which I see at Waitrose. So I think it's not just that Waitrose is probably now losing some of its clientele. I would actually suggest it is losing it to Marks and Spencer's Food.
It's interesting though, isn't it? Really, I mean, you're a Waitrose shopper though, aren't you? Because I mean, you've got it. That's like it's literally next door to where you are, isn't it?
Yeah, we have a flagship shop just next to us. Yeah.
So, but I've always thought with I think so. You've got your Tesco's, Sainsbury's, Asda, Morrison's, and Waitrose. Right now, I don't go to Morrison's because there isn't one near me, and I think they tend to be more in the north of England.
Yeah.
Asda again, not near me, so I don't really go there. But I do think with the thing is, if you look at say the more expensive grocers, I would say if you look at what's the difference, why would you go to M&S or why would you go to Waitrose? I mean, I think first of all, people would perceive that there is a superior quality. Maybe you buy fruit and veg and it will last longer. If you buy it from, because I find this, if you buy it from say, I say buy it from M&S because literally about, I'd say 100 meters from where I live here, there is an M&S. So sometimes I will get the odds, especially, fruit and veg, for instance. I know that they will last longer than say if I go to Aldi, which is in the other direction. That's great, Aldi. The prices are great. It's got the stuff, but the broccoli's a bit rubbery, that kind of thing, and it gets, it doesn't last as long. But I kind of think that for a lot of people with Waitrose, people will go to Waitrose for like a weekly shop, right? Because it has everything. But I went there recently. I haven't been for ages, and I went there, and I thought, I went there the other day, and I thought I was only in there because I happened to be close to it, and we needed a few bits, and I thought, why would you come in here and not go to Sainsbury's, for instance? Because it's basically all the same stuff. And, there's a few things that are kind of Waitrose, that are Waitrose, but most of it is very much, it's the same, the same beans, the same ketchup, the same, all that kind of stuff. Whereas with with M&S, I think people go in there because they think, oh, we need a few sort of, I don't know, meals for two or meals for one, or I want a nice dessert, or I want and you kind of go in there for that. There's something to go in there for. Whereas I think Waitrose, you don't kind of go, I must go to Waitrose for this. I don't think. But I don't know. Am I being unfair there?
No, I don't really know. I'm not that much of an expert on supermarkets because, as you rightly say, I probably go to Waitrose because it's just here and it's easy for me to get there, and it's a flagship shop, so I'm likely to find anything I want there.
Actually, your Waitrose is very good. Actually, I have to say.
It's just a big shop, and I can also go to Tesco's, and I have to say that quality which I find there is also good.
Yeah.
So I talked earlier about the mid-market segment. In terms of food quality, it's not necessarily visible to me.
No.
I mean, some of it may be, but my Tesco's has a limited offer on bakery goods, whereas the Waitrose has a fantastic bakery. Yeah, but that may just be that my Tesco's isn't that good in that regard. And if you go to a bigger Tesco's, you have a fantastic baker.
Right,
so I wouldn't really know. And the M&S food one, I just think the quality there is excellent, and as you say, they do a good deal. They
Mm,
good do a dinner deal for two or something for
mm,
15 quid or whatever it is,
mm, mm,
and and so this is what we just had yesterday,
mm.
and but there's a serious point here, which is of course that in offering that type of deal, that makes a retailer attractive, and
Mm,
that makes a supermarket attractive.
mm,
In the very tightly competitive world of supermarkets, where you can compete visibly or meaningfully on price, which is the
yeah.
discounters, Lidl and Aldi,
Mm,
but then the other thing you need to compete on is range of selection. What can you get there? And second and third, of course, quality of food.
mm,
But that is where it gets very subjective as well. Of course,
yeah.
you
Yeah.
mentioned the broccoli is a bit rubbery. Well, maybe that's just your unsophisticated taste. And I don't know. I couldn't
Yeah.
wouldn't wish to say anything in this
Yeah. Yeah.
regard, of
Yeah.
course. No, but seriously, again, if I go to our Waitrose shop here, you have this wine cabinet, which is a sort of a lofty space with a hermetically sealed door, and you go in, and then you have all this unbelievable wine, Rothschild's 1963 for
Right.
250 quid or something. I mean, I don't
Yeah.
know. I'm making this up. I'm not a
Yeah.
wine drinker,
Yeah.
and so you have that. So clearly there is a clientele there. There is a market for this.
Mm,
Uh, and they might actually go to the Waitrose flagship shop for that. But it's getting very sort of, we're scraping at the bottom of the barrel here,
mm,
because if you're a wine connoisseur of that quality, you surely you will have your specific wine shops
mm,
which cater to your taste. So
mm,
in the end, yeah, I'm back at where I was at the beginning of my commentary. I find it comforting that the mid sector um, brands like Tesco, Asda, etc., have done
mm,
well.
mm,
Because to me, that indicates that pressures on household income are possibly more muted than we would have expected.
mm. Yes. Interesting. So yeah, I think yeah. So we'll see how it goes, obviously, but at least they've got a good Christmas as a launch pad, I guess, into 2023. Right. So let's talk about the next subject, is about the financial sector. Quite a lot of interesting stuff going on in here. And so for investment banks, for instance, we've been hearing, particularly, I'd say over the last 6 months or so, how a lack of deals, a lack of M&A, so mergers and acquisition, a lack of IPOs, initial public offerings, all those kinds of things, they've dried up. And the fact of the matter is that for investment banks, this is what earns them the real money, because fees from trading are fine, but they are it's very, very narrow margin, and you need a lot of volume there. And but the actual advisory fees are very fat, and that is what makes up a vast majority of what many investment banks have. So we heard from some brokers last year, Berenberg was one of them that was talking about cutting staff, and then we had some of the other ones. So Numis and Peel Hunt, for instance, having a tough time. And then this week we saw that Goldman Sachs decided that they're going to cut 3,000 staff. Now the thing is that Goldman Sachs is known as a place which is not shy of culling people. There is a certain, I believe that there is a certain percentage of performers in Goldman Sachs where they will cull the lowest performers. Although you think, well, actually, a lot of places will do that, but I think that Goldman Sachs is well known, is more, has a reputation for it, and so obviously they're going to be doing that because the deal flow has dried up. But yeah, so that has been happening across the board. but yeah, I mean, first of all, what do you think? What do you think about that, Ralph?
Well, yeah, I mean that's almost the opposite indication of what I just said earlier. I mean, what I said earlier is that pressures on household P&Ls were perhaps more muted. That to me is an indication that, of course, we're not living in rosy days. We are living at a time where we are moving into recession. We are in a recession already. And obviously the world economy is not in for a few high growth years in the near future. And that is always felt early in the investment banking sector. And the reason for that is actually the compensation structure which most investment banks have, which is low basic salary and a potentially high variable salary on top.
You say low basic. I mean, the salary is still pretty good, but yeah.
Yeah, low relative to the overall package.
Yeah. Let's just get that sorted.
Yeah. Well, I wouldn't know, of course, but I heard this.
Yeah.
Anyway, no, but it is still true. I mean, low relative to the overall package. So you have a certain basic salary, and then you have a potentially high variable salary, which is meted out in terms of bonus. Now, the idea here is, of course, that for investment banks, that makes the biggest expense item in the P&L, which is expenses for salaries for staff, naturally sort of geared towards the economic activity which they see. If there's less economic activity in terms of M&A, you pay less bonuses, and that is basically then a good thing. Once you get to having to sack people, it means that even the basic salaries which you pay out are felt as too high an expense item to compensate for the lack of economic activity. And that is what we see. And you mentioned Goldman Sachs because it was in the news, but I would agree most, if not all, investment banks and broker houses in the city of London and of course on Wall Street act or set up in this way. So it doesn't surprise me. It is an indication of thin time. You're clearly being sick here.
No, just cough. Anyway, yeah.
It's making me sick. The overall economic doldrums we're in. So where was I? So I'm not surprised to see that it is an indicator of weak overall economic activity, and it links up very interestingly with the part of the financial services industry, which is not actually a bank itself, investment bank, but the accountants, which appear to have had much better time and have been able to build a war chest.
Actually, yes, on that subject then, I mean, like you say, with investment banks, so it's not just investment banks that suffer, it's the whole kind of, food chain. So you've got the advisors on the deals and things. And there was a very interesting, article that was out, this week, was talking about US lawyers' billable hours have hit their lowest point since the financial crisis, and I think that this is interesting because again this is just more evidence of it's more evidence of a lack of activity. Basically, it's not just bosses trying to cut the bonus pool. It's actually is a real thing. But in addition to that, which is what you were referring to earlier, is that there was some more interesting news flow that was talking about EY, one of the big four accountants. They're talking about splitting up their auditing and consultancy businesses, doing an IPO, and then using some of the money from the IPO, and they're saying $2.5 billion as a war chest to buy other stuff. Now, I particularly would say on this that some specialist firms, like let's say some M&A boutiques, for instance, who've not seen much work over the last year or so, they could become very attractive targets for an EY consultancy who wants to grow a business where you can have lots of services under one roof. Yeah. And I would suggest that a lot of companies who are specialists in their area may be vulnerable to takeover, because especially ones that have suffered because of the lack of activity. So it could be specialist law firms, say M&A boutiques, advisory boutiques, all that kind of stuff could be interesting. And from an EY point of view, it would be great, because they could go in theory, you'd think that they could go into a client, do some consultancy, and then the client says, well, actually, we might need to do this and this in the future. And then EY says, well, let's bring in our legal experts. We bought them last year. They are specialists in this area. Here you go. And then suddenly all this cross-selling opportunity just explodes, in a good way. So anyway, I think it's quite interesting, the way that the deals, the lack of deal flow has led to certain things happening. But ultimately, it may mean that there is some kind of consolidation within the financial sector, or and the financial services sector.
Indeed, absolutely. Well, I find this actually quite interesting. I mean, if you wanted to build a large group with all financial services under one roof, which is what you sort of indicated, and now is the time to do it. Isn't it? Because there are lots of M&A boutiques, there are lots of, well, maybe not lots of, but there are some law firms which are suffering from expense structures that they are not able to adjust in time to lack of or reduced economic activity. And they might find it very interesting to sell themselves, because it may not actually change anything much for them. They would just be owned by a larger group. Whereas the larger group would be able, in time, when economic recovery activity returns, to offer their clients a easier and more comprehensive service product, where indeed all the various various steps in the service chain are available under one roof. They would also purchase a client roster, so to speak, and hence benefit from the purchase in this way. And finally, of course, and this is nothing new, but if you are, for example, Ernst & Young, then whatever measure you have that is equivalent to return on equity will, of course, suffer from high amounts of excess cash. And if you're just generating cash, which doesn't do anything for your business rather than sitting on your balance sheet, that's not an efficient way of using cash. You have to do something which turns this cash on the balance sheet into earnings generating assets, which of course means you can buy some other companies. And so there seems to be something here which would, I think, potentially stimulate the building of larger scale financial conglomerates, because there's excess cash available, and some of the smaller companies may feel the pinch, so to speak, in the P&L from the reduced economic activity.
I would say that they want to feel the warm embrace of a larger entity.
Oh my goodness! Is that what Ian Y was saying in his PR literature?
I don't know.
That sounds very good.
I like to play. I mean, we're still 1 month away from Valentine's Day. And anyway, yeah, I don't know why I brought that up.
I like
it's all still about warm embrace, which to be fair, I did bring up, didn't I? I mean, you did not elicit.
I did not
such
at all.
A statement. No.
In no way did I do this. However, now that it has been put out there, I like very much the idea of a warm embrace, because it would mean that I could actually pay less in electricity costs, which are crippling.
I like it, yeah.
Hence my hats, by the way.
Exactly. Very good. Well, this is my teddy bear fleece that I've got on at the moment. It's blooming living this thing.
Why do you call it teddy bear? I shudder to ask.
Because it's the material of a teddy bear. So don't worry, no teddy bears were killed in the
making of
this garment. Okay, so don't worry about that. But yeah, it's quite. I still find myself sort of stroking it from time to time. But anyway,
and we have to go.
yeah. Is that the time? Anyway, so yeah, I think we better stop it on there.
I think so too.
But anyway, look, thank you very much as always for a very entertaining chat about some of the themes for this week. So anyway, have a great weekend, and I hope everyone watching or listening to this has a great whatever you are doing at this time, and we'll be back again soon. Many thanks.
Thanks, guys, for listening.
Bye.